Good morning everyone. I am Atchaya, Assistant Professor in the Department of BCom CS, Fatima College. Now I am going to explain about the financial accounting. Now we can see about meaning of accountancy. Accounting is the art and process of recording, classifying, analyzing and communicating the financial information about a business which helps to make a decision regarding future preferences. We enter in the journal art of recording, classifying the ledgers and communicating the results to the internal employee, external employee and stakeholders, whichever the shareholders who will invest in our business, it will lead to our company's growth. Next we can see about the golden rules of accounting. There are three golden rules in the accounting. First one is personal account. Personal account formula is debit the receiver and credit the giver. Nominal account, which relates to debit all the expenses and losses of a business and credit all the income and gains, which means expenses and losses includes depreciation, bad debts, advertisement expenses, packaging charges, etc. And credit and income includes net profit, gross profit, income from gains, etc. Then we can see about the real account. Real account full and full depends on asset basis. Debit what comes in, credit what goes out. This is what of golden rules of accounting. Next we can see about the journal entries. How to record the journal entries in the books of accounts. Journalize the following question. Here I enter the question. First one is purchase for goods for cash, purchased furniture for cash rupees 3000, sold goods for cash 8000, paid salary 8000, received rupees 800 from Kamal, goods purchased on credit from Mano 2000, commenced a business with cash 50,000, cash deposited into bank 3,000, cash withdrawal for personal uses 5,000. Now we can enter these 9 journal entries in the books of accounts. First question is goods purchased for cash. For that we will put the journal entries like this. The column for journal entries is particular, debit and credit. Goods purchased for cash. This entry will come under purchase account debit to cash account. It includes nominal account, which we are spending the money for expenses, rupees 10,000. Second journal is purchased furniture for cash. It depends upon real account, which means furniture is an asset. Debit what comes in, credit what goes out. Furniture account debtor to cash account. Third journal is goods sold for cash. Goods sold for cash, which also means nominal account, which credit income and gains. Cash account debtor to sales account. Then next one is paid salaries. It also depends on nominal account. Salary is expenses. So we are debiting the salary account debtor to cash account. Next one is fifth journal is cash received from Kamal. We are receiving a cash of rupees 800 from Kamal. The journal entry for cash account debtor to Kamal account. Next one is, this is credit basis. Credit basis is nothing but we will enter the name or particular representative name of the person. Purchased goods from Mano for rupees 10,000. The journal entry is purchase account debtor to Mano account. We are purchasing the goods on credit from Mano. We are not paying the cash immediately. So we will enter purchase account debtor to the particular person's name. Next one is commence the business with the capital, which means commence means starting a business. Cash account debtor to capital account. With cash we are introducing a business. We are investing the business. So cash account debtor to capital account. Eighth journal entry is cash deposited into bank, which means the cash amount is we are entering into the bank, depositing into the bank. So bank will receive the amount, cash is going out. Bank is receiving, cash is going out. So the journal entry is bank account debtor to cash account. The last journal entry is withdraw the cash for personal use, which means the investor withdrawing the cash for his or her personal use. The journal entry is drawings account debtor to cash account. These are the journal entries which we have seen. Next we can see about the basic accounting terminologies. First one, capital. Capital is the amount invested by the business or owner, which we call input of the business. From that input only we can start a business. Next one is asset. Asset is nothing but anything the value owned by a business. It can be a tangible asset or it can be an intangible asset, current asset, fixed asset, etc. Then liability. Liability is a temporary interest of outside creditors in a business. Liability also which divided into particular variable concepts. Current liability, long-term liability. Next one is tangible asset. Tangible asset has a physical existence. They can be feel or touched. We can say the tangible assets like furniture, plant and machinery, land and building, which are called fixed assets, are called tangible asset. Next one is intangible asset. Intangible asset has no physical existence. They cannot be feel, they cannot be seen, they cannot be touched. Examples of intangible asset is goodwill, patent, copyright and etc. Next one is drawing. Drawing which we see already. Drawing is the amount withdrawn by the owner for his or her personal or official use. We can call the personal use as drawings and we can call the official use as cash. Next one is invoice. Invoice is a statement prepared by the seller to the good seller for the goods sent by the buyer. It's like a bills received from a shop. Next one is solvent person and insolvent person. Solvent person is a person who is capable for paying his debt and liability in a particular period is called solvent person. He is eligible to in the company. He will pay his liabilities and debts within the financial year. He is called solvent person. Then we can see about the insolvent person. Insolvent person is a person who is not capable of paying his debt and liability are called insolvent person. These are the basic terminologies in accountancy. Thank you.